Thank you for joining. We'll be getting started momentarily. Please let me know if you cannot hear the audio. So I see we've got uh, listeners logging in, so we'll give it a moment. Please let me know if you cannot hear the audio. Please like this video and please subscribe for more videos like this. We appreciate everyone taking time to join. So we'll get started. Today's presentation, we're going to be going over the Mega Backdoor Roth procedure for a self-employed business which is taxed as a partnership. That could be a multi-member LLC or just an unincorporated partnership for tax purposes. So we'll get started. So the focus of the presentation is again going to be geared towards someone whose self-employed business is organized as a partnership, a multi-member LLC. So that means that the individual is filing a 1065 and receiving a K-1. So as you can see from this slide, and we'll circle back and we'll dig a little deeper here as far as what that means in a second, but you can see that for purposes of determining how much the person can contribute, you're going to start with line 14 of the K-1, and then you subtract 1/2 of the self-employment tax to determine the self-employment income. So the starting point for being able to make a Mega Backdoor Roth contribution is you first have to have you have to be eligible. So you've got to be self-employed with no full-time W-2 employees. You have to find a provider that's going to offer a plan that allows for the voluntary after-tax contributions and in-service distributions. So that would be a conversion or a rollover, whether you're keeping the money in the plan or you're rolling it out to, say, a Roth IRA. So you also want to look for a provider that's going to assist with establishing the required sub-accounts. So you got the pre-tax accounts, the Roth accounts, the voluntary after-tax accounts, and then providing the ongoing compliance support. Because the foundation of being able to make a Mega Backdoor Roth contribution is you are taking advantage of the higher contribution limits that apply to voluntary after-tax contributions. But then what happens is you move the money from the voluntary after-tax account to either a Roth IRA or a Roth Solo 401k. So that move is going to be a reportable event. So a 1099-R has to be issued. So you want to make sure that you work with a provider that's going to provide that compliance support and prepare the 1099-R, because many do not do that. So the starting point in determining how much you can contribute are the factors that are listed on this slide. So you've got your self-employment income. And again, we'll review that again, what that means for a partnership. Your age, are you 50 or older? If you're 50 or older, the limits go up. Whether you participate in another plan, like a 401k plan through a day job, the type of contribution that you're looking to make. Are you looking to make employee or employer, pre-tax, Roth, or voluntary after-tax? Now, digging a little deeper as far as what self-employment income means for a business that's taxed as a partnership. So it's going to mean line 14 of the K-1 less 1/2 of the self-employment tax. So you have to do that pre-calculation. You don't consider W-2 wages from other sources. You don't consider your investment income. It's just got to be that earned income. So if you go back to this slide, you can see that self-employment income, not based on passive income. You use line 14, code 1 of Schedule K-1. This is the net profit line. subtract 1/2 of the self-employment tax. And our Solo 401k calculator does this for you. So then moving on from this slide, so we're first going to now dig deeper in terms of the different contribution types. So you got the employee contribution, which can be made as a pre-tax contribution or as a Roth contribution. The employee contribution limit is 100% of your self-employment income. Remember, that's that pre-calculation. Line 14 of the K-1 less 1/2 of the self-employment tax. So once you've figured out what that number is, you can do dollar for dollar, 100%, all the way up to $19,500, or an additional $6,500 if you're 50 or older. And that's for 2020. So if you set this plan up before December 31st of 2020, you would have preserved the right to make 2020 contributions anytime up until your business tax return deadline in 2021. And then going forward for 2021 contributions, the limit stayed the same. It's $19,500 or $26,000 if you're 50 or older. Now keep in mind this first sub bullet here. You need to reduce it by any contributions made to another plan, unless the other plan is a 457 governmental plan. So the employee contribution limit applies at the employee level. So if you are participating in another plan, like through a day job, and you make contributions to that other plan, you have to reduce how much you can contribute to the solo 401k by the amount that you contributed to the other plan. So if you put in 19.5 and you're under 50 to your day job 401k plan, you can't make any more contributions to the solo 401k because you already used up the bucket. Now the Roth contributions are under the same category. It's an employee contribution. It's also referred to as a salary deferral. So just like on the prior slide, you can do 100% dollar for dollar up to $19,500 or $26,000 if you're 50 or older. If you're making a Roth contribution, it needs to go into a separate sub account. So you would have, say, a bank or a brokerage account in the name of the plan for your benefit for pre-tax funds. And then you have a second account, second bank or brokerage account in the name of the plan for your benefit and under the EIN of the plan for the Roth money. And I see we've got a question. Thank you so much for asking that question. We'll get through the section of slides here, and then we'll turn to these good questions. So the employer contribution limit is calculated differently. Employer contributions are also referred to as profit sharing contributions. Again, you start with that pre-calculation. Line 14 of the K-1 less 1/2 of the self-employment tax. And then of that number, you can contribute 20% as an employer contribution. Keep in mind that the overall limit, though, cannot be exceeded. So when you add up any employee contributions or after-tax contributions that you're making to the solo 401k, the overall limit cannot be exceeded. The overall limit for 2020 is $57,000 or $63,500 if you're 50 or older. For 2021, it's $58,000 or $64,500 if you're 50 or older. Now here, note the difference. For the purposes of the employer contributions, the limit is at the employer level. So even though you might have made contributions to another 401k plan, like the day job plan, made by you or made by the employer, like a match, you don't have to consider those for purposes of you just take your self-employment income and you just figure out what the 20% of that is and make sure you don't exceed the overall limit to the solo 401k. Next slide, voluntary after-tax contributions, which is how you get it to be able to make the Mega Backdoor Roth contributions. So here, the limit is the lesser of the self-employment compensation. So that's that pre-calculation figure, the line 14 of the K-1 less 1/2 of the self-employment tax. The lesser of that number and the overall limit, which again is $57,000 for 2020 or $58,000 for 2021. And then you reduce it by any employer or employee contributions that you make to the plan. So not contributions made to another plan, but just the employee or employer contributions made to the solo 401k. And note that if you're 50 or older and you made a catch-up contribution to the solo 401k, you don't have to reduce it. You don't have to reduce this limit by that catch-up contribution, that $6,500 figure. So the last bullet here, we talked about the first two, but the last bullet is that the voluntary after tax, like the Roth, need to go into a separate sub account. So that's where you'd end up with potentially 3 accounts for each participant. One could be a pre-tax account, a second is a Roth account, and then a third is an after-tax account. Now let's address this good question before we turn to the scenarios. So how much can a 1099 NEC contribute? Can they have employee, employer? So a 1099 NEC is actually going to be considered a sole proprietor. So it's addressed by, we have a separate presentation geared towards sole proprietors, and I'll include a link to the comments. But it's going to work very similarly in that you have to do that pre-calculation, and then you could do, of that, you can then make the employee, the employer, the after-tax contributions. Good question. So the next set of slides is going to go through different scenarios and thanks for that follow-up question. Let's go through these scenarios and then we'll address that question. So it's going to address different scenarios to illustrate the point, some key points here. So the baseline, we want to set the baseline base scenario assumptions. So here we're going to talk about a self-employed business that's taxed as a partnership. So it could be a multi-member LLC taxed as a partnership. It could be an unincorporated business taxed as a partnership that's filing that Form 1065 at the federal level, and a K-1 is issued to the partners. So we're talking about just a one participant scenario, under 50 years of age, does not make contributions to another plan. They first want to maximize their pre-tax contributions to reduce their taxable income. And then anything that's left over, they put it into the Roth and or voluntary after-tax bucket. And then lastly, we're assuming that this individual has $100,000 of self-employment compensation. So they did that pre-calculation, line 14 of the K-1 less 1/2 of self-employment tax. And the product of that calculation was $100,000. So in this baseline scenario, the individual is going to be able to contribute 100% of their self-employment compensation up to $19,500. They put it in as a pre-tax contribution because they first want to maximize their pre-tax bucket. They could also do 20%, so $20,000 as an employer contribution. So now they have $39,500 in that pre-tax sub account. And they could do the difference as a voluntary after-tax contribution, which will go into that separate voluntary after-tax sub account. So the difference is going to be $17,500 for 2020 or $18,500 for 2021, and then can move it from the after-tax to the Roth bucket. Now we change it and we do reduce the self-employment compensation to $50,000. So that, as far as the first employee contribution, it's going to be the same. It's 100% up to $19,500. The employer contribution goes down because it's 20% of the self-employment compensation. So now they do another $10,000 as an employer pre-tax contribution. Employer contributions are always pre-tax. So now the individual has $29,500 in their pre-tax sub account. They can do the difference as a voluntary after-tax contribution. But here, note that the limit is the lesser of the self-employment compensation of the overall limit. So their overall, so the limit's going to be $50,000 because obviously $50,000 is less than the overall limit. So they'd just be able to do the difference up to 50, which is going to be the same for 2020 and 2021. So it's $20,500, which could be deposited into that separate voluntary after-tax sub account and then moved over to the Roth account. Now let's go back to the base, but change it to a scenario where the person makes $19,500 to their day job plan. Here, they're not going to be able to make any employee contributions because they already used up that bucket. So they could still do the $20,000, so 20% of the $100,000 of self-employment compensation as a pre-tax contribution, since their first initial goal is to maximize the tax reduction and make a pre-tax contribution. And then they could do the difference up to $57,000. So that'd be 37,000 for 2020 as an after-tax contribution, or 38,000 for 2021, since the limit went up to 58,000 for 2021. Put it into that voluntary after-tax sub-account and then move it over to the Roth. Now let's go back to the base and make a different change. So now we're going to assume that the person doesn't want to maximize the pre-tax contribution, they just want to make Roth and or voluntary after-tax contributions. So they could do 100% of their self-employment compensation, but in this instance, instead of putting it into the pre-tax sub-account, they put it into the Roth sub-account. They skip their employer contribution because employer contributions are always pre-tax, and this person doesn't want to make a pre-tax contribution. And then they just do the difference. So in this case, they do the difference as an after-tax contribution. So that would be an additional $37,500 into the after-tax bucket for 2020, or they could do $38,500 into the after-tax bucket for 2021, and then move it from the after-tax to the Roth. So at the end of the day, they've got $57,000 in their Roth sub-account for 2020, or $58,000 in their Roth sub-account for 2021. Now let's go back to the initial scenario. We're going to assume everything's the same, except now we've got two participants. So how do the limits change? Well, they don't. So again, in that base scenario, they first want to maximize pre-tax. So they put in $19,500 as a pre-tax employee contribution. They do another 20% or $20,000 as an employer pre-tax contribution, giving them the $39,500 in their pre-tax sub-account. And then they do the difference up to the overall limit as an after-tax contribution. So that's $17,500 for 2020 or $18,500 for 2021. The point that we're trying to illustrate here is that each person, because we're assuming that each person has $100,000 of self-employment compensation. So each person could make these contributions into their own separate set of accounts. So in this scenario, they might have 6 accounts: a pre-tax account, a Roth account, and an after-tax account for each participant. So now let's go back to the base and change the age. So let's assume the person's 50 or older. So how do things change? So instead of making a $19,500 pre-tax contribution as an employee, now the person could do 100% of their self-employment compensation up to $26,000 as a pre-tax. They still do the 20% of the $100,000 as an employer pre-tax, giving them $46,000 in their pre-tax sub-account, and then they do the difference up to the overall limit. But note here, they ignore the $6,500 for purposes of figuring out how much they can contribute as an after-tax contribution. So effectively, they're making $63,500 worth of contributions for 2020 and $64,500 worth of contributions for 2021. So that means they could do. So you really don't change that. That means you don't change how much you can contribute as an after-tax contribution. So they're still able to do that $17,500 after-tax contribution for 2020 or $18,500 after-tax contribution for 2021, and then move it from the after-tax account to the Roth account. Now let's go back to the base. The person's back under 50 years of age. They're contributing $19,500 to their day job plan, and then they want to not make any pre-tax contributions, just make Roth and or voluntary after-tax contributions. And I see we got more questions coming in. Thank you so much for asking. We'll get through these scenarios and then we'll go through the questions. So because they've already maximized their bucket to their day job plan, they're not going to be able to make any more employee contributions to the solo 401k. They skip the employer pre-tax contributions because they're not interested in pre-tax contributions. So they really could just do up to $57,000 or $58,000 for 2021 as an after-tax contribution, and then move it from the after-tax sub-account to the Roth Solo 401k, or it could go to a Roth IRA. And we'll talk about in the next set of slides moving it out of that after-tax account. So now let's go to the next change. We go back to the base, but now let's make multiple changes. Now we're back to a person that's 50 years of age or older. The person's maximized the contributions to a day job plan, so they put $26,000 into their day job plan, but they want to maximize the Roth contributions. So what's interesting about this is that what they can contribute to the plan doesn't change because the after-tax limit doesn't go up to the solo 401k on account of the fact that they're 50 or older. So they're still just able to make $57,000 as an after-tax contribution for 2020 or $58,000 for 2021. So now we're going to here really be changing a lot of scenarios. We're back to the person being under 50 years of age. They maximize to the day job. They just want to make Roth and or voluntary after-tax contributions, but it's two persons. So in this scenario, they've each already maximized to their respective day job plans. So they cannot make any more employee contributions. They don't want to make employer contributions to the plan because those are always pre-tax. So they just put all the money as an after-tax contribution. So $57,000 for 2020, or again, $58,000 for 2021. And so one of the key takeaways here is that each person could make that $57,000 or $58,000 contribution, because we're assuming that each person is participating in the plan and each person has $100,000 of self-employment compensation that each person reports. So before we get into the next set of slides, which is the mechanics of making the contributions and other related issues, I'm going to go back to these questions. So then thanks again for asking the question. So for an S corporation, the employer is pre-tax. Well, employer is always pre-tax. Make sure we keep that in mind. Can this be transferred to after-tax, then to Roth IRA? No, you cannot transfer money from a pre-tax account to an after-tax account. You can transfer to a Roth Solo 401k sub account, but then you have to meet triggering rules. There are rules about when you can transfer the money out of the Roth Solo 401k sub account. You have to meet a triggering event. So if the goal is really to get the money into the Roth IRA, you just don't make employee or employer contributions and focus on the after-tax contributions, because the rules for transferring after-tax funds out of the Solo 401k are that you can do it at any time. So unlike the pre-tax contributions or the Roth contributions, where you have to meet that triggering event in order to transfer it over to the Roth IRA, you don't have to meet a triggering event. You can just transfer it from the after-tax sub-account to the Roth IRA. And as far as the pro rata rules, with respect to IRAs, they don't apply. There are pro rata rules that would apply to the 401k, but those are addressed by virtue of the fact that you have separate sub-accounts. That's why it goes back to the beginning that one of our first slides, that when choosing a provider, you want to make sure that you have one that's going to help you, guide you through all those compliance issues. That's why it's so important that you're putting the money in separate sub-accounts. So next question here. Is it possible to put away employee pre-tax and Roth, and then also do the voluntary after-tax? Yes. So for example, let's say that you are under 50, it's kind of like the baseline scenario, but you have $100,000 of self-employment compensation. You don't make any contributions to another 401k plan like through a day job. So you're able to contribute $19,500 as an employee contribution, 100% of your self-employment compensation up to $19,500, which would clearly be at that if you have $100,000 worth of self-employment compensation. So you can make that employee contribution as a mixture between pre-tax and Roth. You might put in $10,000 as pre-tax and $19,500 as Roth. And then you could do the difference up to the 57 or the 58 as an after-tax, and then move that into the Roth. So at the end of the day, you might have, 47,000 or 48,000 in your Roth and 10,000 employee pre-tax contribution that you made. So hopefully that answers your question. Next question: can you do a $6,500 catch-up if 50 or older and $300,000 of self-employment? In other words, do Roth income limits apply to the solo 401k? Great question. No, they do not. So unlike a Roth IRA, where your ability to make a Roth IRA contribution phases out once your AGI is too high, those income limits do not apply to a solo 401k. That's one of the big differences between a Roth IRA and a Roth solo 401k. So thank you for those good questions. So please don't hesitate to ask more questions. In the meantime, we'll proceed with the next set of slides. So how do I make contributions? So of course you can make the contribution by writing a check payable to the name of the plan and writing annual contribution on the memo section of the check. Electronic transfer is also acceptable from a 401k perspective. you're going to want to check with the financial institution that holds the accounts. Now, a lot of people have their solo 401k account at a brokerage. I would note that other than Fidelity, most brokerage firms don't allow incoming electronic deposits from external accounts as a general rule. So keep that in mind. Please note that each participant is going to have their own separate sub-account. And then you might have underneath each participant might have a pre-tax account, a Roth account, and an after-tax account, which is how you could end up with 6 separate sub-accounts. When is the deadline to make contributions? So the deadline to make all types of contributions, so employee, employer, and voluntary after-tax contributions, is the business tax return deadline, assuming that the plan was set up by the end of the tax year. So for a partnership, the business tax return deadline is March 15th or September 15th. And we've got a snippet from IRS publication 560 because this often is a point of confusion because the rules that apply to full-time employer plans, in other words, a 401k plan that has non-owner employees participating, those rules are different. But the deadlines for self-employed individuals is really the business tax return deadline, which makes sense from a practical perspective because often the self-employed individual doesn't even know how much they've made until after the end of the tax year, because they might be working all the way through December 31st to make the money, and then after the fact, figure out how much they can contribute. So how do I report contributions? So here, the contributions need to be reported on line 15 of the schedule 1 of the 1040. And this is a wrong title here. Just know that we're talking about partnerships. So line 15 of the schedule 1 of the 1040, as well as line 13 of your K-1, if it's a pre-tax employee contribution. So if it's that pre-tax employee contribution, it gets reported on the K-1, and it gets reported on schedule 1 of the 1040, line 15 of schedule 1 of the 1040, and line 13 of the K-1. Roth contributions doesn't apply. After-tax contributions doesn't apply. Employer contributions, it's the same place. Line 15 of schedule 1 of the 1040 plus line 13 of your K-1. So how do I convert after-tax to Roth? So you can convert the money. So we're talking about, again, the Mega Backdoor Roth. The foundation of that is the voluntary after-tax contributions, which go into the separate after-tax account. And then that money gets moved out of the account into a Roth account. So the money can be moved by check, electronically, contact a financial institution about their procedure for transferring the funds electronically. We have clients that have accounts at hundreds of different banks, brokerages. So every institution is going to have their own procedure. You can transfer between bank and brokerage. I mean, let's say that you have a brokerage account at Fidelity, but you want to invest in cryptocurrency. So typically the brokerages are not allowing the money to go out to the cryptocurrency exchange, and the cryptocurrency exchanges require that the money come from an account that matches the name on the account at the exchange. So transfer it from the brokerage account to a bank account. So you could have a voluntary after-tax account at a brokerage and a Roth solo 401k account at a bank. And you could do that conversion from that after-tax brokerage account to that Roth bank account. You can also transfer to a Roth IRA. So you might have the brokerage account for your after-tax funds at Fidelity, and you want to invest via a Roth IRA. Let's say you have a Vanguard Roth IRA because you have a certain Vanguard mutual fund that you want to invest in, that you need a Vanguard Roth IRA to invest through. So you could transfer the money from the after-tax sub-account of your solo 401k to that Roth IRA. So we'll keep going through these next set of slides as far as conversion, and then we'll come back to some of these good questions. Thank you. So the steps for Schwab are mapped out on this slide. So you first make the contributions, step 1. So you have to have the brokerage account at Schwab, which we prepare as part of our services for the after-tax funds. So you might have 3 brokerage accounts at Schwab, a pre-tax, a Roth, and an after-tax. You make your voluntary after-tax contribution. You then convert it to Roth. So one option is you move it over to your Roth Solo 401k brokerage account at Schwab. Another option is you go to a Roth IRA at Schwab or a different institution. And then step 3, report the conversion. So we have an online form where we capture the information that's needed for the required 1099-R tax reporting. Because whether it's going to a Roth Solo 401k or a Roth IRA, it has to be reported on a 1099-R. So we've got a different form whether you're going to a Roth Solo 401k versus a Roth IRA. And you can find those forms if you go to our website under the Learn menu, click on Forms. Fidelity, it's going to be a similar process. You open the account, which we prepare the forms. You make the after-tax contribution. You convert to the Roth Solo 401k, or you convert over to a Roth IRA. And then you let us know about the conversion so we can capture that information that we need for the 1099-R reporting. We also have a lot of clients that open accounts at TD, again, where we prepare all the paperwork. You make those contributions subject to the limits that were described in the prior slides and in the prior scenarios. You then can convert the money from the after-tax account to either the Roth Solo or a Roth IRA, whether it's at TD or another institution, and let us know about the conversion so that we can prepare that 1099-R. So before we turn to the next set of slides, let's keep going through these good questions. So when do you send it the 1099-R? So the 1099-R is issued at the beginning of the following year. So by February of the following year. So for example, the 1099-Rs are being issued for conversions that were done by our clients in 2020. Presently, those are being issued. And it's just going to be one 1099-R, even if you did multiple conversions. Let's say you did multiple after-tax to Roth conversions. That's just reported in aggregate on one 1099-R, but we ask you to submit the online form for each conversion so that we have a good paper trail. Follow-up question, can I then contribute employee $19,500 and employer 20% to after-tax and then move it to Roth IRA? No. So you cannot contribute the 19.5 to the say pre-tax or Roth bucket and then move it to the Roth IRA. So if you really want to just ultimately get the money into a Roth IRA, you can just skip the employee contribution. You can skip the employer contribution, the employee pre-tax or Roth contribution, skip the employer contribution and just make 100% of your self-employment compensation dollar for dollar up to the overall limit of 57 or 58, depending on which year you're making the contribution to, into that after-tax bucket, into that after-tax sub-account, and then move it to your Roth IRA. And then let us know about the conversion so we can prepare the 1099-R. So thank you for those good questions. Please don't hesitate to keep asking questions. We're going to keep going through these slides. So here, now we've got some information about should I convert to a Roth IRA or a Roth Solo 401k. So let's look at some of the differences. So with a Roth IRA, that is not an employer plan. So distributions can be made at any time, sort of how we were discussing previously in the questions, that to move money out of the Roth Solo 401k account, you've got to meet a triggering event. With a Roth IRA, there's no triggering event that has to be met. Another key point is that Roth IRAs are not subject to required minimum distribution. So once you hit 72 with the Solo 401k, including a Roth Solo 401k, those accounts are going to be subject to the required minimum distribution rules, and you have to start taking money out of the account, unless, of course, you move it over to a Roth IRA, in which case now the funds would not be subject to the RMDs. Last bullet point, participant loans are not permitted from IRAs. So with a Roth Solo 401k, you can borrow. You can borrow up to 50% of the balance, not to exceed $50,000, as a Solo 401k participant loan. It's going to be payable monthly or quarterly, equal payments of principal and interest. The interest is prime plus 1%, or it could be prime plus CD rate plus 2%, excuse me. So it's either prime plus 1% or it's CD rate plus 2%. Those payments are spread out over a 5-year term, and it has to be documented on loan documents. We prepare those loan documents as part of our service for no additional charge. So the ability to take that loan does still apply to a Roth Solo 401k. But unlike the other bullet points, they are subject to RMD. So unlike a Roth IRA, a Roth Solo 401k is subject to the required minimum distribution rules. And you have to meet a triggering event in order to take distributions. So for example, you got to be 59 and a half. That's the common triggering event. Now, we talked about how there is a deadline to make the contributions. It's your business tax return deadline. But there's no deadline to convert the money. So once you've made that contribution, there's no deadline to move it from the after-tax account to the Roth account. It is going to be reportable for the year of the conversion. So you might be making a voluntary after-tax contribution for 2020 here in 2021, for example, by March 15th or September 15th of 2021 if you file a timely extension. If you convert the funds in 2021, the 1099-R will be issued in 2022 because it's issued for the year of the conversion. And then it's that 1099-R is going to report the amount converted on line 5A and any gains on line 5B. And that's for the 2020. That's for your 1040. I mean, so the 1099-R reports the amount converted plus gains, which then you have to translate over to your 1040 on line 5A and line 5B, just to be clear. And again, just to emphasize, we handle that as part of our services. So we have an online process to let us know about those amounts that are converted so we can capture that information that we need to prepare the 1099-R. So don't hesitate to ask more questions. Thanks to everyone for your continued participation. So if you're watching this on a video, you can ask questions in the comments and we get back to those questions within 24 business hours. So let's go through these next set of slides, which just continue to illustrate the account structure. So in this slide, you've got a one participant plan that has pre-tax, Roth, and after-tax contributions. And so that means you've got three separate accounts, one in the name of the plan for the pre-tax money, a second in the name of the plan for the Roth money, and then a third in the name of the plan for the voluntary after-tax funds. This next slide builds off of that, where now we have two participants. So we touched on this on the prior slides, but this just illustrates it. So now you can see that we've got 6 accounts. One set of accounts for Jane, a second set of accounts for John, pre-tax, Roth, and after-tax. And then here, we're illustrating how the contribution rules and how the money flows. So let's say that the person just puts in pre-tax money and then they do the balance as an after-tax account, because let's say that they want to first put in $19,500 as a pre-tax contribution, and then they do their 20%, $20,000, say, as a pre-tax employer contribution. So that goes into that same pre-tax sub-account, and they do the balance as an after-tax account. So then the money goes into their after-tax sub-account, and then they're converting it from the after-tax account to the Roth account. So they're not making direct contributions to the Roth. It's first going into the after-tax and then being converted to the Roth. Now let's illustrate how it would work if the person instead wanted to convert it to a Roth IRA. So then it would go, first they maximize to the pre-tax, then they do the difference to the after-tax and then convert that money over to the Roth IRA. Or per the questions, let's just say you skip those pre-tax contributions, make all the contributions as an after-tax, and then move it over to the Roth IRA. So we've come to the end of the slides. I don't see that we have any more questions. Please don't hesitate to ask more questions. Or again, if you're watching on a video, you can, a video recording, you can ask questions in the comments and we'll get back to you within 24 business hours. This last slide does have a nice breakdown of the steps of opening up the account, making the contributions, letting us know about the amount converting the funds over to the Roth account, whether it's a Roth IRA or a Roth Solo 401k, and then the 1099-R is issued to report that conversion. So we'll include a link to the other Mega Backdoor Roth webinars for S corporations and sole proprietors in the comments. Thank you so much, everyone, for joining. Please like this video. Please subscribe. We would really appreciate that, so you get notifications of our weekly webinars. I don't see any more questions or comments. So thanks again, everyone, and have a great day.